Good morning, everyone. My name is Sriram from the Commodity and Currency Research Desk at Reliance Securities. This is the commodity and currency outlook for 9 September 2022. Starting with the commodity side and starting with energy, international oil prices rebounded in yesterday's session and after amid bargain buying and as Russia threatened to halt exports of oil and gas to certain buyers. The price rise also came in despite a big build in inventories of about 8.8 million barrels in the previous week amid a combination of increased imports and ongoing releases from government emerging reserves. Natural gas prices also moved higher after EIA reported that utilities added about 54 BCF of gas to storage last week, which is in line with expectations, but this is still below the 5-year average of 65 BCF. So markets continue to move higher in yesterday's trade. Looking ahead, prices both crude oil and natural gas have started with small gains this Friday. Again, crude oil can be supported amid supply disruptions, but worries that central banks will hike or will continue its aggressive monetary policy path could dent the fuel demand and will cap upside for the crude oil side of things. On the gas side, we see markets continue to move higher, but next week there is forecast of weak demand, at least from the US side of things, and as European gas prices have also eased over the last few days, and that could also weigh on the prices for natural gas in the coming week. So range for crude oil in the coming couple of sessions will be anywhere between 6,500 on the lower side to 7,000 on the upside of things, and domestically we see natural gas prices remain between 600 to 650 over the next couple of trading sessions. Moving to bullion prices, gold prices struggled on Thursday and ended in the red. In fact, after Fed Chair Powell reiterated expectation around a 75 basis point in their next meeting, Fed Chair said that he and his colleagues remain committed to cool inflation going forward and hope that this aggressive hike may not lead to a recession, and they can do without doing this triggering a recession. So Fed stance continues to remain hawkish. Additionally, we saw the ECB also hike rates by 75 basis points, and they also increased their refinancing rate to 1.25%, which is the highest since 2011. So aggressive policy rates have begun from the global central banks, and this will cap any upside for gold and silver prices. But the dollar has eased over the last couple of sessions, and further weakness of the dollar and further correction there can lend some support to the bullion side of things. We see markets can remain range bound over the next couple of trading sessions. The next big trigger for the bullion markets will be the CPI data from the US next week, and that will be the key trigger possibly driving both the dollar and the gold going forward. So all eyes will be on that. Until that time, we see markets remaining within a broad trading band of 1675 to 1750 for the international side, and domestically we see a range of 50,000 to 50,800 for the coming few sessions for domestic gold October contract. Briefly on base metals, copper and aluminium surged higher in yesterday's trade on worries that stoppages due to high energy prices and other disruptions will spur shortages. Yesterday we also found out that workers at BHP Escondida mine in Chile, which is one of the largest producer of copper, have gone on a strike starting yesterday. So that will definitely lead to a supply problem going forward, and that lends support. Additionally, Chinese cabinet has announced several steps to support the economy yesterday, and this will also spur some demand for the metal side, and this also lifted markets higher. So looking ahead, prices have started on a positive note, and again supported by the Chinese steps taken to support the economy. But the supply disruptions expected over the next few days will be the key driver of the prices going forward over the next few sessions. So domestic copper can remain within a broad trading band of 630 to 650 over the next few sessions. Finally, on the currency side of things, currency and bonds, the Indian rupee opened stronger this Friday against the dollar, tracking the decline of the greenback against its major peers and the Asian currencies. Asian currencies have started extremely positive, with offshore Chinese yuan also remaining on the positive side of things this Friday's trade, and had a rub-off effect on our currency. Of course, importer dollar demand will cap gains. So the rupee can remain within a broad trading band of 79.50 to 79.85 in this Friday session, but overall we see 79.50, 79.45 to 80.15, the broad trading band for the currency over the next few days. The main trigger, like the commodity markets, will be the CPI inflation number from US. Of course, domestically we also have the CPI number and the IIP output number, which is due next week, and that will be the key trigger for the currency market next week. On the bond side, we see bond yields likely to remain subdued going forward. Bond yields have fallen significantly over the past few days. Again, fall in the crude oil prices has aided sentiments, along with rumors that the domestic bonds will be included into the global bond indices has aided sentiments. But today we have the weekly auction of debt, and the Indian government is seeking to raise anywhere between 320 to 325 billion rupees, which is about $4 billion, by selling bonds, which including the extremely liquid 5-year and 14-year papers today. So all eyes will be on that. Until that time, markets can remain range bound. After that, we feel that the bond yields can continue to weaken further amid fall in crude oil and rumors that it can be included into bonds, global bond indices. So that's it from our side. Have a pleasant day and have a good weekend. Thank you.